Why holding a single 25,000 dinar note could be your biggest financial mistake? Welcome back to IQD to VND, your trusted source for everything related to the Iraqi dinar, smart investing, and global currency strategies. If you're new to the channel, don't forget to hit that subscribe button. We're just 10 subscribers away from hitting our milestone of 300. And we'd love for you to be part of our growing community. Today, we're going to explore something that has the potential to completely reshape how you think about your financial future. It's a hard truth, but one that needs to be addressed. Holding on to a few 25,000 dinar notes and hoping for a miraculous revaluation might be the biggest financial mistake you could make. And here's why. Part 1. The illusion of the penny investment. You've probably heard the saying, "A penny saved is a penny earned." While that may apply to daily budgeting, in the world of investing, holding on to pennies can become a trap. In this case, pennies are low-value or underperforming assets that offer limited potential for future gains. The Iraqi dinar, especially in small denominations, often falls into this category. A startling statistic illustrates this perfectly. The average dinar investor holds just 125,000 IQD, about 525,000 dinar notes. This number reflects a larger issue, a dependence on hope over strategy. Many investors aren't building portfolios. They're gambling on a dream. Part 2. Understanding the psychology of dinar investing. It's important to understand why so many investors fall into this trap. The psychology of hope plays a huge role. Hope is powerful. It fuels belief, encourages patience, and can help people remain optimistic through tough times. But hope without strategy becomes blind faith. Many investors cling to their dinar because they believe in the narrative that Iraq will recover, revalue its currency, and everyone holding a note will become rich overnight. Unfortunately, history shows us that speculative assets rarely perform miracles. Relying on hope alone creates a mental block that prevents people from making better financial decisions. Part 3. Diversification. The core of smart investing. Diversification is one of the most fundamental principles in investing. It simply means not putting all your eggs in one basket. When you hold on to only one type of asset, in this case, a single foreign currency, your entire financial future is tied to the fate of that asset. The risk here is significant. If the value of the dinar never increases, or worse, declines, your entire investment could be wiped out. A diversified portfolio spreads risk across various assets like stocks, bonds, real estate, precious metals, and stronger currencies. If you had invested the same money used to buy dinar into something like an S&P 500 ETF, Bitcoin at the right time, or even a high-yield savings account, your returns would likely be higher and more predictable. Part 4. The concept of opportunity. One of the biggest lessons in economics and investing is the idea of opportunity cost. What you miss out on when you choose one option over another. If you invest $100 in dinar and hold it for 5 years without any gain, that money could have generated returns elsewhere. Opportunity cost is often invisible, but incredibly damaging. By locking up your money in low-performing assets, you're foregoing better financial opportunities that could help you build real wealth. Part 5. The myth of market timing. Another dangerous mindset is trying to time the market. Some investors are convinced that they just need to wait for the right moment. A change in leadership, a global economic shift, or some political event to cash in. Timing the market is notoriously difficult, even for professionals. The more you wait for the perfect moment, the more opportunities you miss. Instead, consistent investing and smart diversification usually outperform attempts at timing the market. Part 6. Inflation. The silent erosion. Even if the value of the dinar doesn't drop, inflation can still erode your purchasing power. Inflation slowly but steadily reduces the value of money over time. Holding on to cash or low-return assets means that your money is actually losing value, even if the nominal amount stays the same. To protect against inflation, your investments need to grow at a rate that outpaces inflation. Most speculative assets, like the dinar, do not provide this protection. In contrast, assets like real estate, stocks, or inflation-indexed bonds often do. Part 7. Emotional attachment to investments. Investing is as much about psychology as it is about numbers. When you've held on to something for years, it's easy to become emotionally attached. This emotional bias can cloud your judgment and lead you to make irrational decisions, like continuing to hold a declining asset simply because you've had it for so long. Emotion should never drive financial decisions. A successful investor makes choices based on logic, data, and strategy, not feelings. Part 8. Currency revaluation. Separating hype from reality. The idea of a currency revaluation is central to many dinar investors' hopes. A revaluation means that a government decides to increase the value of its currency relative to others. While this has happened in history, it's incredibly rare and usually based on strong economic fundamentals. Iraq's economy is heavily dependent on oil and faces numerous structural issues, including political instability, corruption, and limited economic diversification. These are not the ingredients that typically lead to currency revaluation. Part 9. The Trump effect and speculative theories. Some investors speculate that a change in U.S. leadership, particularly a Trump presidency, might trigger favorable conditions for the dinar. While political shifts can impact global markets, there is little evidence to suggest that any specific administration has direct influence over the valuation of foreign currencies like the dinar. Betting your financial future on political speculation is risky at best, and financially dangerous at worst. Part 10. Taking action. How to move forward. If you've held onto dinar for years and are now questioning your decision, don't panic. It's never too late to reevaluate your strategy. Here's a step-by-step guide to moving forward. 1. Educate yourself. Read books on investing, watch financial videos, and understand different asset classes. 2. Assess your portfolio. Take a hard look at what you own and why you own it. 3. Diversify. Start adding a variety of assets to your portfolio to reduce risk. 4. Set goals. Define what you want your money to do for you. 5. Manage risk. Never invest more than you can afford to lose. 6. Stay informed. Follow global economic trends and adjust your strategy accordingly. 7. Connect with other investors. Engage in communities focused on education, not speculation. Conclusion. Investing in the Iraqi dinar might seem like a small gamble, but for many, it becomes a large emotional and financial commitment. Holding a single 25,000 dinar note may not seem like a big deal, but when it's part of a larger strategy based on hope rather than analysis, it becomes a problem. The good news? You're in control. You can shift your mindset, learn from past mistakes, and build a diversified investment strategy that truly supports your long-term financial goals. If this article resonated with you, share it with someone you know who's invested in the dinar. Let's start a smarter, more informed conversation about money, investing, and building wealth the right way. Subscribe to IQD to VND for more insights, updates, and deep dives into the world of foreign currencies and smart investing. The future is yours. Plan for it wisely.